Hey everyone, Intuit, the company home to TurboTax and QuickBooks, reported fiscal 2023 third quarter earnings results that sent the stock price falling by 7%. So in this video, I'm going to review the big picture highlights from the latest quarter's earnings, and then I'm going to update my buy recommendation on Intuit stock. Coming into the quarter, I had the stock rated as a buy, and I'm going to update that recommendation, letting you know if there's any changes or if it stayed the same. You're not going to want to miss that. Let's get right into it. Total revenue increased by 7% to $6 billion. Earnings per share increased to $7.38. That was up from $6.28 in the same quarter last year. Of course, Q3 is the biggest quarter by far for Intuit due to the filing of taxes in this quarter. Intuit's consumer group segment, which includes the tax filing revenue, boasts an operating profit margin of a whopping 76%. Those are incredible operating profit margins that are now at risk. Why is that at risk? Well, the IRS is now funded with $80 billion thanks to a stimulus package passed in the US, and the IRS is considering developing its own tax filing software. If it does indeed follow through with that, that could put Intuit's TurboTax business at risk of experiencing a significant decrease in revenue. So that's something to keep an eye out for. The total number of returns in the quarter fell by 2% this year due to fewer filers now that the pandemic era stimulus tax credits have ended. However, the average revenue per tax return increased by 12% due to price increases and incremental service add-ons. QuickBooks Online accounting revenue jumped 25% year over year. Remember, that segment has done an excellent job switching over from physical copies on desktops and hard drives to online service based accounting, where folks pay a monthly subscription fee, which is far more lucrative for QuickBooks overall. The company's forecasting revenue growth of 12.5% for 2023. That was up from a previous forecast of 11%. Intuit is forecasting earnings per share growth of 7.5% for the year. That was up big time from a previously expected decrease of 3% year over year. So, all in all, a really good quarter from Intuit. The reason the stock price fell is for two reasons. Number one, investors were expecting better than what Intuit reported. So even though the quarter was good, it was not as good as investors were expecting, especially the outlook for next quarter. And then secondly, I don't think management did enough to assure investors from the risks of the IRS coming up with its own online filing software. I don't think management did enough to quell those concerns, but maybe there isn't that much that management can do, right? It's somewhat seems like out of their control, although there may be some partnerships that Intuit could work out with the IRS instead of the IRS spending all that money developing their own program. Could they maybe partner with Intuit and have Intuit develop that software or use Intuit software? Maybe there is some collaboration potential there, and maybe investors were disappointed that management did not talk more about that or elaborate on that potential. But that's a big overhang over Intuit stock because that segment is so profitable and it consists of such a big part of the business overall. To answer the question, is Intuit stock still a buy in my recommendation? And I will say yes, the stock is still a buy, although I am aware of these risks from the IRS developing their own tax software. I'm keeping an eye on that. Still, I haven't seen enough for me to change the recommendation. I will keep an eye on it and I will update you if there is a change to that forecast in my opinion. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.